Hey traders, this is Ron Haight. Hope you guys are having a fantastic extended weekend. As always, nothing in this presentation shall constitute a recommendation to buy or sell any security. Trading stocks and options involves risk and specific financial issues should always be addressed with your financial advisor. We'll kick off here with the Qs. Now keep in mind the market is closed today in observance of Martin Luther King Day. Well, the Qs, they are above their moving averages, all except one. If I zoom in here, the blue line is the 5-day EMA, and keep in mind, you can see what the averages are right up here. So blue's 5-day, where we've been above that. Red is 20-day, we've been above that for a couple weeks. The orange is the 50-day SMA, institutional moving average, and the purple is the 200-day institutional moving average. So we're above 3 of the 4. Now, the 200-day, which is the next target at this stage, coincides with this reversal in December on the 3rd. Above 171, if I zoom out just a little bit, above 171, there's a little high here in November and a little one here, just small little highs. The real target's up here. I would say from a technical perspective, above 171, which is about, $6 higher, 185, the old highs would be the target. Now, I'm not saying we're going to get there, but from a technical perspective, the targets are laid out here, and then I would say up here. I mean, you could be really particular and say, well, if we get above here, then we go here, then we go here. But there wasn't a lot of price action, and it wasn't exactly a massive reversal. I mean, yes, there was reversal here, and here we came down too, but once we get above one of these, I think it outweighs the other two. That's why I'm saying that. We can get above one big reversal, which this one was, then these two probably are not going to hold that much weight once we conquer the first one. Now, what if the markets start rolling over? I would say watch the red line, the 20-day EMA. We get it below that, then we start coming back down to these swing lows and even a retest of the lows potentially from a technical perspective. And that's how we're going to look at all the major index ETFs as we go through here. And then I'll give you my thoughts just looking out over the next month or two as well. So let's take a look at the SPY, the S&P 500 ETF. It's almost at its 200-day. It's maybe another 5 points, 50 S&P points away. But the 200-day SMA in purple is sort of in the middle of this box. This was a little tougher. So you get resistance there, $5. Then there's like another $5 or $6, and then you hit the top highs, the previous highs right here, and then back up to the all-time highs. Again, I'd watch the 20-day EMA. A break below that on a closing basis to me would be bad news. Normally I talk about the 50-day being a big deal, but the 50 days, sort of in between now. So I want to use something else. Once we start getting up the 20-day higher and higher, we could then maybe look at the 50-day as a bigger key. The fact that we're only 2 days above the 50-day doesn't carry as much weight right now as the 20-day would. The diamonds, DIA, tagged its 200-day on Friday. Target, previous double top, 260. If we can get above the 50-day, which right now is around, what is that? I'm sorry, the 200-day. The 200-day right now is around 247.64. We're merely 60 Dow points away from conquering that, and then boom, we come right back up here. Now, overall, if I look at the daily charts, actually, let's just do IWM quick. It's been 3 days above its 50-day, something it could not do in December. Target up here, right around 157, which coincides with these highs right here. That's the target. That's 10 points. That's a big deal for the IWM. Not saying it's going to get there. Now, if I wrap all this up, how are we setting up? Well, we have earnings this week in a big way. Last week was expiration for January monthly options. We're through that. We've had the rally. In all the indexes, we're now back up and into the previous trading range. Anything can happen. We can go up or down. I mean, that's not rocket science, right? But keep in mind, watch if we get below the 20 days. That's a bad sign. Otherwise, upside is the target. The market seemingly has now rallied off of the December crash, which what I told you in December was the stuff that's sort of coming out, the market knew about. It's a little surprising that it decided to just fall out of bed. Well, now it's rallying, and I would say a little surprising it's rallying as much considering what it sold off on the month before. Let's pay attention to the news events. If we start rolling over and volume picks up, which it probably will, boom, it's right back to the lows. And one big down day could easily put all of the major indexes right below their 20 days. So if I look at a couple months, the bulls have an edge right now in the daily charts. I'm just very cautious. I'm sort of like 1 foot in, 1 foot out of looking over your shoulder, It doesn't feel good as it should. if that makes any sense. Again, that's just my opinion. The charts are bullish, but I'm sort of a little wavering here. I'm not exactly trusting this. I had a question on the volume dropping off as the markets are going higher. It's a good question, but that does typically happen when the rallies come back. Usually the bottoms, if we get that big capitulation, which would have been, Christmas Eve, but then you're talking about a market bottom right over a major holiday when traders are away. It doesn't happen in a major, trading week. So the fact that the up volume, the black is days the market finished higher. So that's going to be the up days. These are the down days. The up days are not even, close to the down days. If you look at some of this, I mean, maybe that one day was, but then it quickly came right back down here on the S&P. So yeah, it is sort of expected, but again, the way the bottom happened, we didn't get a capitulation bottom, and it was a holiday week. So that's why we're seeing some of this volume differential, if you will. Now, looking long term, mega bullish. If we would get a pullback here and the market rolls over, I think it could present, in my opinion, a fantastic buying opportunity. Even now, if I were to look out, a year from now, I think we're going way higher. Remember, I've said that for months. I've said that during the decline. I said it again in December. Short-term movements can shake the lemmings from the tree. It's what can happen. Then all the talking yo-yos on TV, I'll say, yep, this is the mother of all bears. I think they've lost sight of why the market's rallying, which is what I've shared with you a bunch of times. It's not the standard metrics why the market is going higher. It doesn't know where else to go. That's the capital. It's the most liquid market in the world. And if you want a return on your money, the U.S. market is it. It's not in a bank account. It's not in the euro. It's not in the Aussie dollar. It's not in the Canadian. It's nowhere. It's the U.S. stock market. And that is a completely different set of, call it principles or metrics in terms of why it could go higher. And I think why it's been, because a lot of folks have been calling this market, for a dead duck now. If we go back 10 years, they were saying it in 15, then 16, then 17, then this year. I mean, so far we haven't gone down much at all in comparison to where we were in 08 and 09. This has been a massive rally. Now they're trying to claim that they're all right because they called the top. We'll see how this plays out. I mean, I trade the charts. You can have opinions. You've got to be careful you don't get locked into them. And then when the market does not go in your direction, there's no hedging. And that's when you can pay a heavy price. So you do want to trade what you see, not what you think. But everybody has an expectation of what might be coming down the road. And I still think we're going way, way higher. I'm not saying tomorrow, but if I were to look out a year, 2 or 3, I do think we move higher. All right, now, NFLX. Thursday of this past week, I did a twofer. It was my last twofer of seeing the hottest stocks for 2019. To kick the year off with a bang, I should say. I told you guys to watch NFLX beginning of January in a paper trading account, always educational purposes only. And look what happened. The stock went up as much as $90. A March at the money call option, you can use Thinkorswim, think back to quote, prove it to yourself, went from right around the 2nd of January up into here was as much as almost a triple. An at the money option was something like $25.30 in March, I think at the end of the second. Well, I can show you. If we want to look at analyze, let's look at March 2nd. We'll just do this as a fun exercise. If you take a March 2nd at the money option, strike was 270, right? It cost $25.30. If you then look and think back as only to the 11th right now, oops, that 270 is worth $74.55. So just round it off. 25 became 75, or as much as 75, right? That's a triple. In fact, that was on the 11th. If you look at, if I zoom in here, the 11th was here. The stock closed at 337. We were up above 350. It was as much as $88 a share. I mean, it's 3.5 times. It was insane. So $2,500, again, paper trading account. From here, a $2,500 contract up to $8,800 before earnings. This is when Netflix is in its window for rock star status, where it typically begins the window when it has soared historically. So if you'd follow along on paper, you would have seen that's amazing. Now, I get a question on exits and how would I handle something like that? I think a great way to practice is take 3 contracts, just for fun, paper trading, literally write it on a piece of paper. You're not using real money here. January 2nd, 3 long calls end of day are purchased. First one off at 20%. Well, that didn't take long. Second one off at 100%. Well, that didn't take long. Now the third one, literally we, and see how long it goes. And when that stock closes below the red line, the third one is then exited. If you follow that principle on paper, you do the math, the third contract's actually risk-free at that point. So it allows the trade to be aggressive and see if we can catch a home run. And then if you go back and you look at Netflix a year ago, there was the earnings report. Actually, let me go back 2 years just to show you how this plays out. Here's 2 years ago. Stock runs up into earnings. I think from here to here was around as much as a 90% return. Post earnings, you had the gap up, and then until it really cleanly closed below the red line. It was all the way in here in March, but that was only the third contract at that point. That's why I explained in the seasonality webinars. It's why I kept telling you guys, you need to be there, you need to be there. I showed you the stock. Netflix is one you gotta watch, and it on paper paid off in spades, I guess you can say. All right, let's keep moving here. Here is the NVDA, NVDA. Not a massive season bullish window right now. We are seeing some spikes in volume. It finally is above the 50-day. If I want to be bullish on NVIDIA, I would probably use a red line as a end of day trailing stop. If it gets below there, I would just cut it and then say, you know what, looks like we're in a trading range, because technically we are. Watch how I draw this. And then I can even take it back and literally catch that spike down low. It really needs to get above 175 and then target a gap fill at 200. But if I really wanted to try and play this now, it better stay above the red line for me. All right. Going back to Netflix, there was just a question on the earnings. This time it's moving a little lower. Netflix having this kind of run up and that kind of move on it after earnings is nothing. All it's done is it's trying to fill the gap. And if I zoom in closer, you can see the purple line is the 200-day SMA. If it falls below the 200-day in purple, then it goes to the red. Below the red, that's the stop out that I teach from an educational perspective. So as long as it stays above the red line, this would just be a pullback and hopefully a potential bounce. How about Tesla? I haven't talked about them in a while. No real reason to. I mean, if you look at this, look at the highs at 375-ish. This is just for horseshoes, right? 375, 380. Just can't get above it. Support, 250. That is one whopping range. Well, on Friday, the stock got creamed. Now you're back at these previous lows around 300. It breaks 300. Now it's back to 250. So it's like 50, 60 up, 50 down. You're right in the middle. And earnings is coming. So that's why I don't talk about it. It's still one big hot mess, very driven on news reports. Here is Schlumberger. In October, it was around 60-ish. Then it gets down to 35, almost a 50% haircut. Now it's starting to pop higher, and look at the volume bars. Once it put the bottom in, the blacks are beating the reds. So the up days are beating the down days. From a technical perspective, we had earnings on Friday. We're now up. The target, frankly, might as well be the 200-day. Why not? All the way up there, around 57, 50, 58 bucks. That's the real target. I would use a 20-day EMA as a potential trailing stop to consider. Again, paper trading account. Here is Northern Oil and Gas. I found two really cheap stocks just to have some fun with on paper. There's the possibility of inverted head and shoulders. Left shoulder here early December, the head Christmas Eve, and the right shoulder, frankly, just last week. We get above the 200-day, that would be noteworthy. I mean, it is only a $2.80 stock, but you get above there, and then you take out these highs right here around 315 or so. The next resistance level are the highs, 4.25. You're talking about on paper a 50% move before resistance comes in. I would also consider using, once we break that 315 area, the red line is a trailing stop. You can see here, once we got below it, it pretty much stayed below it until now we're starting to get above it. So like I said, it works. It seems to work more often than it doesn't in terms of the red line. And here's DSKE. Try that again, DSKE, another cheap stock. This is a $4 stock. At one point it was at 13. Now we're down in the threes. But if I zoom in here, big volume on Friday. We're above the 50-day, and we just took out the previous high. The next ledge support where the stock came down and bounced for about a week and a half was 6. That's almost 50% higher. Then it's the 200-day just because it's there. And then all the way back up towards 9. Potential trailing stop, I would go again with the red line, 20-day EMA. So two little cheapies just to have some fun with and see how momentum plays out, as well as talk about the overall market. Short term, not feeling exactly right in the overall market, but the bulls do have the edge. If I want to be bullish, I just want to be cautious, not quote all in. And if we get below the red line, like on the S&P, which is the 20-day EMA, that's where things get dicey. Wish you guys a fantastic week ahead. I'll see you in the next video.